Well, hello everyone. This is welcome to Collaborate Session 2, which is pre-recorded, and I had a request just to do a kind of intro to non-controlling interests. So this will be it. So I'll just quickly go over assessment 1, which, as you know, is coming up, and then do an intro to non-controlling interests, or NCI as we call it. Okay, well, there are the assessments. As you can see, 1, 2, 3, 4, and you only need 50% to pass. It's worth 20%, as you know. We went over this again in Collaborate 1. You have one attempt. You'll be presented with the worksheet, and it'll be very similar to the practice ones you've been doing. You'll have to complete a worksheet based on a certain amount of information you're given, and you can do the journal entries, but you don't have to. That's what that bit means. So if you're confident just putting the numbers in the worksheet and getting them right, then that's good enough. And before you start, it's good to get your technology ready. Check it, double check it, and make sure it's working, because that's the last thing you need when you're in the middle of it. Okay, let's have a quick introductory look at the non-controlling interest part of consolidation. Now, by definition, the non-controlling interest, often referred to as the NCI, is the amount of partly owned subsidiary or subsidiaries equity that is allocated to ownership interests outside the group. So this interest is not in the group. And if we look at Australian Accounting Standard Board's 10 consolidated financial statements, it bases the parent-subsidiary relationship on the concept of control and the derivation of benefits, rather than the ownership of issued share capital. So in the old days, if you owned 100%, you controlled it, but now you can control it with a lot less. And you may well have a parent entity that has a subsidiary in which the ownership interest is less than 100%. And if this is the case, then we have two classes of ownership interest in consolidated equity of the group, one of which would be the interests of the shareholders of the controlling parent entity, and the second of which would be the interests of the non-controlling shareholders. And what we do with this NCI, or non-controlling interest allocation, is we're allocating the consolidated equity balances of the group between the interests of the parent entity shareholders and the non-controlling interest shareholders. That's the whole point of the exercise. So, interestingly, they did a study of Australian groups, and they found out that over 90% of subsidiaries were wholly owned, which you can see here. And they found that with the partly owned ones, which were less than 50% of ownership, only about 1.3% were held with a non-controlling interest. Nevertheless, AASB 10 has an entity focus, and it requires us to prepare and present consolidated financial statements for a group, irrespective of whether it's wholly owned or includes partly owned subsidiaries. So we have to do it anyhow. So the nature of a non-controlling interest really is, this is where the parent entity controls a subsidiary but owns less than 100% of its voting shares. So this creates a situation where the ownership interests include both the shareholders of the parent entity, which we refer to as the PI to save time and typing, and the non-controlling shareholders in the subsidiary, which we can call the non-controlling interest, or NCI. So let's say, for example, the shareholders of A Limited are the parent interest of the A Limited group. And subject to any consolidation or eliminations and adjustments, the parent interest in the group is equivalent to all the equity of A Limited, and that's the A Limited group makes this up, and 70% of the equity of B Limited, known as a subsidiary. So The non-controlling interest shareholders in B represent the other ownership interest. If we have a look at a nice little chart here, you'll see that in consolidation accounting, the accounting entity is the group consisting of a parent entity up here and its subsidiaries, and that's down here, but frequently it's a corporate combination, so it's a group. If the group consists of a partly owned subsidiary, as it does in this little simple example, then the ownership interests in the group are not limited to the shareholders of a single entity. So these are not the only people interested here. It actually extends into two distinguishable shareholder groups. There's one, and there's the second one. So the shareholders of the parent entity are one shareholder group, and the outside equity shareholders who own 30% are outside the group. And this non-controlling interest, in a partly owned subsidiary is held by shareholders other than the parent entity or shareholders in other subsidiaries. And whenever the ownership of a group does include these outside shareholders, then it's necessary to partition the equity of the group for accounting purposes. And that's between the ownership interests of the parent entity and the non-controlling interest. So we've now got to partition the equity here. So continuing with that analogy, now logically the ownership interest in B must add up to 100%. And this principle applies to all partly owned subsidiaries. And here where we say direct, parent entity interest direct, non-controlling interest direct, that means that the ownership interest in B Limited, i.e. in this case we're talking about the ownership of its shares, are held directly, as opposed to being held indirectly through another entity in the group. And if there's more than one partly owned subsidiary, then the non-controlling interest will actually be the aggregate of all the equity in the group attributable to non-controlling interest shareholders. And if we go back again to AASB 10, Appendix A, it defines non-controlling interest in this aggregate sense to mean the equity in a subsidiary, sorry, I tied my tongue in a knot there. It defines it in this aggregate sense to mean the equity in a subsidiary not attributable directly or indirectly to a parent. Phew, try and say that fast. So it's the aggregate. Now, the relevance of the ownership interest for consolidation. I mean, why do we care? Well, it's important to realize that the consolidated financial statements are not prepared for the use of the NCI shareholders, and they're actually of little relevance to these financial statement users. And we have basically two approaches when we do this consolidation. And it doesn't matter what proportion of a subsidiary's equity is held by the parent entity under the first one. So we call this the entity concept or the full consolidation approach. So under that approach, it doesn't matter what proportion of the subsidiary's equity is held by the parent. If the parent has control, then the full amount of the subsidiary's income, expenses, assets, liabilities, equities are included in the consolidated financial statements for the group. So that's what we call full consolidation. There is another way, and that is the proprietary concept of consolidation, or proportional. And what we do here is it treats the ownership interest of the parent entity as the only relevant interest in the group. And I suppose strictly applied, income, expenses, assets, liabilities, and equities of the partly owned subsidiaries are only consolidated to the extent of the parent entity's ownership interest. So if the parent controlled under this model 70% of the voting shares, then they would only consolidate 70% for each item of income, asset, liability under this proportional consolidation model. And no NCI is disclosed because only the interests of the parent entity is included. So that'll tell you we're using full consolidation. And people who do use the proportional model argue that it's more relevant than full consolidation, especially if a parent owns less than all the shares. And we won't go into the proportional one, other than that you be aware of it. Okay, so again, going back to the AASB 101 here, the presentation of financial statements requires the allocation of the non-controlling interest to be disclosed as follows, and it lays it all out in AASB 101. But you've got to do the NCI in equity, in profit and loss, in comprehensive income, and you've got to disclose that in changes of equity to the comprehensive income. So it's ordained by the accounting standards. Now, again, the non-controlling interest should be presented in the consolidated statement of financial position. That's AASB 1022, and it's got to be separate. And the profit or loss and each component of other comprehensive income are attributable to the owners of the parent and the non-controlling interest, that 10B94. And the only thing that AASB 10 and 101 do not require disclosure of is the non-controlling interest in each equity balance in the consolidated financial statement. So most of you will know the reason we're doing all this is because we have to. It's not a choice. The standards have said so, and with IFRS and the rest, we've got to do it. Alrighty, so for each subsidiary in the group that is partly owned, we've then got to measure somehow the NCI share in the subsidiary's issued capital, reserves and surpluses, contributed opening retained earnings to the group, contributed profit or loss for the period to the group, the dividend distribution for the current period, and the transfers to or from reserves for the current period. And remember that the objective of this non-controlling interest calculation is to show how much of the net assets of the group is represented by shareholders' equity balances that are attributable to the NCI and the parent, respectively. That's the point of the whole thing. Okay, so here we can see a nice graphic. And what we're saying here is, again, following the same analogy as earlier, the NCI have a 30% share, and here we've got the shareholders' equity of B Limited in the outer circle, and then we've got retained earnings and so on here. And what this means is the closing balances of issued capital, reserves, surpluses, and retained earnings in a statement of changes in equity should correspond with the amounts disclosed in the consolidated statement of financial position for the parent entity. So in order to identify the parent interest in the opening balances and the closing balances and the changes in issued capital, reserves, surpluses, retained earnings, and also the NCI, ditto, we've got to identify them. So for each partly owned subsidiary, and remember, if it's wholly owned, NCI doesn't enter into it, we've got to measure the NCI's share in issued capital, reserves, as you can see here. We've got to measure the contributed opening retained earnings to the group, contributed profit or loss for the period, dividend distribution for the period, and transfers to or from reserves. So I guess that chart may or may not be handy, or may just be more confusing. So the whole objective is of the NCI calculation to determine how much of the net assets of the group is represented by is represented by shareholders' equity balances that are attributable to the NCI and the PI respectively. So in a very simple example, we can illustrate this process as a beginning sort of launch into your materials. And of course, I'm aware you have audio files galore and transcripts and pages to read. So I'm trying to keep it simple, just to give you an intro, and then you can dive in to the plethora of learning materials. Alrighty, so let's say we have on 1 January 20XO, A Limited acquires 70% of B Limited for $70,000. Also at that date, A gained control of B Limited, and B Limited had identifiable assets and liabilities at a fair value of $100,000, represented by the following equity balances. And there's no goodwill because the cost of the investment in B equals 70% of the identifiable assets and liabilities assumed at fair value. 70,000 is 70% of 100,000. So we can rule goodwill out of this one, which I'm sure will be a relief. Okay, so there's a consolidated worksheet. You can flick back and forth on this as you listen to it, but we've got a reference here and we'll have a look at those. We've got a debit to opening retained earnings of 42, 28 issued capital, 70 to net assets, and then our credits here and our consolidated balances. So in this simplified example, the only asset of the group really is cash, and there are no liabilities. So yeah, it should be remembered that A Limited's investment in B is an asset to A, but not the group. Okay, so to eliminate the cost of the investment against, we seem to have moved to different letters now, but anyway, to eliminate the cost of the investment against the 70% share of issued capital, we have this entry. We debit the issued capital, and going back to here, you can see that this is A here, and we had 28, 42, and 70, and you can see them coming in the previous slide there. So we debit the issued capital, 28,000, debit opening retained earnings, 42, and credit investment, 70. And on the 31st of December, remember that, again, going back a little, that on 1 January 20X0, this is when A acquired it, so that's your acquisition date. And we're now talking about 31 December, a calendar year later, and management decides to wind up the A Limited group. First, they wind B up, and its cash balance of 170,000 is distributed to A Limited and the NCI shareholders. Then A Limited, the parent entity, is wound up, and its cash balance of 249,000 is distributed to the shareholders of the parent. So let's see what happens there. Here's a sketch of it. We had P had 70% in subsidiary, and these are the non-controlling interests. And so the cash distributed was 170, as stated here. And of that, 70% goes to the parent and 30% to the non-controlling interests. And then P Limited distributes 249,000 to the parent interest shareholders here. So if on wind up here, they have a cash balance here, you can see of 249,000. By the way, that's made up of the 130,000 originally held plus the 119,000 here received from the subsidiary. That's where we get 249 from, and that's distributed to the shareholders of the parent entity. So when we, on winding up of the group, the shareholders of the parent entity would then receive 249,000, again, as explained, just back here, total down here. And then the non-controlling shareholders have received their 51,000, again here. And we'd conclude that the net assets of the group at 31 December 20x0 are represented by the ownership interests in the equities of the group, as shown in the slide, which would be that. 249 was the parent interest, 51, and we can do it as a table, which is essentially what we did on the drawing before. Now, there is an alternative method to determine the allocation of the equities, and that's to focus on the ownership of the equities of A and B Limited. But I don't think we'll go into this too much. You can do it the second way, and you perform it in a memorandum account, a thing called a memorandum account. And this would be a kind of memorandum account worksheet. You just be aware of it, I suppose, really. And on this, what we can say is that in the memorandum form, including the non-controlling interest in the equity section of consolidated is consistent with the entity concept, and the NCI is recognized as a liability. And then, when we're consolidating partly owned subsidiaries, we need to determine the NCI amounts in profits. Here we have it done here. Appropriations, capital and reserves of each subsidiary. And these are the processes, by the way, 1 and 2. Determine the consolidated amounts, then the amount in profits. And using this method, in conjunction with any adjustment for the measurement of NCI, by the way, at acquisition date, those preparing the financial statements to determine the NCI, non-controlling interest, in a partly owned subsidiary's net assets can be done. That's the point of it. And we have to do it again because AASB 10B 94 says, quote, an entity shall attribute the profit and loss of each component of other comprehensive income to the owners of the parent and to the non-controlling interests. So we've got to do it. No choices there. At the end of the day, I thought you might be interested in this graphic, which goes through pretty much the whole of the consolidation process and the NCI allocation. And once we've gone through those steps that we've just gone through, it's possible to summarize the whole consolidation process for situations where there is a non-controlling interest in the group by virtue of one or more partly owned subsidiaries. So we've got inputs, processes, outputs, leading to the presentation of consolidated statements of comprehensive income, changes in equity, and financial position. So really, as we've seen, the existence of a non-controlling interest creates an allocation problem more than anything. After we've done the consolidated totals for the group, we then have to calculate the non-controlling interest share and the parent interest share of profit, dividends, capital, and reserves. And that's how we do it. Okay, well, I hope that's been useful to you. And I wish you all a very happy weekend and a great week off next week for consolidation week, for rest and recreation or catching up or whatever your pleasure is. And I will be talking to you on the board soon, and hope you enjoyed it. Bye for now.